The second part of my Chapter 2 lecture is going to focus on a few cases that I've put together to just kind of give you some additional application beyond the homework. First part, we're going to compare relevance with representational faithfulness. Now, ideally, accounting information would contain both of those, but sometimes the FASB has to choose one over the other, and it varies in their decisions. Sometimes they will view that relevance is more important and make a decision based on that. Sometimes they'll make a ruling thinking that reliability, representational faithfulness is more important. And just for a quick review, remember relevance means that the information makes a difference to the decision maker. Representational faithfulness means that the information conveys what it's meant to convey, that it's reliable. So let's get this first case. We have, about the FASB requires companies to include liabilities for retirement pensions as well as post-retirement benefits on the balance sheet. Post-retirement benefits are items such as health insurance that are provided to retired employees. When the FASB deliberated over the issue, many companies argued against the requirement. They maintained that the cost of reporting would exceed the benefits of reporting. So discuss the cost of benefits of mandatory reporting of a liability for pension or post-retirement benefits on companies' balance sheets. Well, I kind of put a little time graph here ahead of time just to save some time, but let's say that employee retires here, and all of this before that is when the employee is working. So the question is, when does the employee earn their benefits? Well, they're going to earn the benefits here, right, while they're working. So those pension benefits and retirement benefits are earned while the employee works during that time period. And so just like salary expense is a cost to the company while the employee works, so are these benefits of the retirement because that's when they're really incurred. We're going to pay on that, though, when the employee retires. So we actually have some sort of expense that should be debited, retirement expense. Sorry about that. Some sort of retirement expense and some sort of liability that ought to be recorded while the employee is working. So that's the thought. Let's do that. Well, why wouldn't companies want to do this? Because it looks like there's real value here. And as you can imagine, if this is pensions, the liability is going to be very material, very large for a company. Well, the argument against it is that, how would you arrive at it? So I'm going to jump to B because actually this is going to have us compare relevance with representational faithfulness. And so the relevance of this is that if we create this expense and liabilities, of course the liability is just going to grow and get really big until the employee retires, and then the liability will go down as the company pays out the benefit during the retirement period. So certainly it's very predictive. It's going to help forecast future cash flows. If we know that liability, we know there's going to be cash flows in the future during the retirement period. It would confirm expectations. We know employees have worked, so there should be some sort of expense about employees working and the benefits accruing to all of that. And it's material. Material means it's a large enough amount that it makes a difference to the decision maker. This is usually a very large item, dollar amount going into the expense, and then the liability, because it keeps growing and growing, becomes very, very material to the balance sheet. And again, materiality means that the dollar amount is significant enough, it'll make a decision to the investor or creditor who's reading the financial statements. Immateriality, if it's not material, it's considered immaterial. If it's immaterial, for instance, if you're off $1, who cares? It's not going to make a difference in my decision. And again, it's going to depend on the size of the company, because sometimes $10,000 is immaterial for some companies. If you got, $100 million balance sheet, $10,000, really, if you're off, if you've got an error of $10,000, that is not going to make a difference to an investor and creditor, whether they loan or invest money to you. It's just not significant enough. Okay, so we can see then here that this journal entry is very relevant. Reporting the liability is very relevant. Well, what about representational faithfulness? Well, it is complete. I mean, it is reporting all the information that ought to be on the financial statement. The question is, though, how would we arrive at the dollar amount? Because, who knows how much we're really going to pay out during retirement, So how do you know what those costs are back here when the employee's working when we don't even know what the cost is going to be? So here's where the argument came in. This is just some huge estimate. And how are we going to arrive at this estimate? Because it's going to depend on, estimated life expectancy of this employee. Maybe there's a marital benefit with it as well, so it's going to depend on the life expectancy of the spouse. And then life expectancy depends on health conditions, where you live, all sorts of unknowns, of variables. Not unknowns, but variables. So, this idea of being free from error, so it's just a huge estimate. Well, how would we rely on that? So in this case, we can see that the representational faithfulness is really in question. How do we arrive at these reliable numbers? Well, we really don't. We're going to have a ballpark figure in order to put a dollar amount there. But the FASB felt that relevance was so important in this particular topic that they were willing to forego some of their reliability or representational faithfulness. So the bottom line, and this is a chapter way towards the end of your book, but the accounting is going to rely on an actuary to do a lot of this estimating for us. But anyhow, this is required. This is a required journal entry. Let's look at the next one. So we've got a company that bought forest land for this amount of money. But then, as things went along, so, here's the original cost. If you kind of read through it, you're going to see on the balance sheet date, here's the mark. If they were to sell this property, here's what it would sell for in the market. So if we were to report this, which is more relevant, cost or market? Well, if I was an investor and creditor, I'd be more interested in market value, correct? Because, especially if I'm a creditor, I'm probably going to use this as collateral, have the company collateralize this so that if they go under, I can go in and take away that property. So it's very relevant because it's very helpful for, predictive value. We can predict future cash flows, that's the market value. It confirms our expectation. If we know about this industry, we know that the values of the forest land are going up. And it's also material. It's a very large difference between cost and market value. So it makes it relevant. Which measure has more representational faithfulness? Well, that's going to be our cost. The original cost, who's going to question it? It's very free from error. Whatever the check amount was, that's what we spent on it. So nobody's going to debate what the cost is. Market value, that's more debatable. We might be able to sell it to John Doe for this amount, but there might be another buyer who won't pay as much. So if market value is more subjective. So if you were an investor, which measure would be most valuable to you? I think we've already discussed. That's going to be market value. And I hope you also maybe will tie this in with my prior part A of this lecture, that market value, when I say that, the new term for that in the FASB's literature is fair value. Fair value. So market value is one component. It's level one of fair value. All right, let's look at revenue and expense recognition. Revenue is an action. We provide goods and services in exchange. It's either going to cause assets to go up or liabilities to go down. Expenses, we're using cost. We use up a cost, the asset will go down, or it might be that we owe money for it and liabilities will go up. Now I also highlighted this third thing on recognition. This pertains not just to revenue and expense, but any time we recognize any element in the financial statements, four things have to happen. It has to meet the definition of an element, revenue, expense, asset, liability, stockholders' equity. It has to meet one of those definitions of an element. We have to be able to measure it. If I can't place a measure on it, I don't put it in the financial statements. That's why employees are not reported as assets, because how would you measure their value? So employees work and we expense their work, but we really don't have a way of measuring the value they do contribute in terms of reporting it as an asset. And it also has to meet the qualitative characteristics of relevance and reliability. So let's look at some applications of the revenue principle. So, by the way, I want to refer you here to page 59 of your textbook. If you haven't looked at that 5 steps for revenue recognition, you should. But basically, if you have somebody, a newspaper, like the Kansas City Star, when does the Kansas City Star earn revenue? When does it, it's going to recognize revenue when it's earned. But when does it earn the revenue? When does revenue earn? Well, if I sell newspapers, is it when I sell the subscription or when we deliver the paper? Well, if you go to page 59 of your textbook, you're going to see the final step in determining that is that we recognize revenue when we meet the performance. And it actually has more wording than that. But when the performance obligation is settled. So we'll recognize revenue when, in this case, when the service has been performed. So when is that? That's when they deliver the paper. So for newspaper, we don't earn revenue by selling the subscriptions. We earn revenue when we deliver the paper. The next one has to do with both revenue and expense. So we have sole enterprises. They manufacture insoles for shoes. They sell to individuals with credit cards. Roughly 4% of those, the credit card company charges roughly 4% of sales. So the credit card companies always gets a percentage of the sale. They also sell to pharmacies on account. So let's go down here. When should sole recognize the revenue? So they sell to individuals, they sell to pharmacies, but what is it they do to earn the revenue? What is the performance that they do? Well, they deliver the insoles, right? Well, when do they deliver the insoles? Well, much of this is through the mail. So, upon shipment. So when they ship the goods, when they ship those insoles, they have earned their revenue. And so they would recognize sales revenue at the point of shipment. Okay, so that's when they're earning their revenue. Now, what about this 4% fee? Well, that's actually a cost, right? That's a cost of selling with credit cards. And let's review costs a little bit. In accounting, costs get accounted for 2 ways. There's 2 ways an accountant will record a cost. Either recorded as an asset or recorded as an expense. Well, what's the difference? Well, assets are benefits, and they're actually future benefits. So those are costs that we have not consumed yet. So we will consume those costs in the future, we just haven't yet. So it's a future benefit. But the expense, that's a cost that's already been consumed. So it has been consumed. We've already used it. So in some ways you might want to think of an asset, it's just a cost waiting around. It says kind of hanging out on the balance sheet, and eventually it's going to become an expense when we fully consume the cost. Okay, so just a little overview between assets and expenses. Okay, so how should they report the credit card? Well, they want to expense it, right? So there's going to be some sort of expense for that. And then, I think I also up here we have bad accounts. 2% of all pharmacy sales go bad. So we also, so here we have credit card expense. And here we have bad debts, or bad accounts if you will, but typically it's called bad debt expense. So we have bad accounts, customers' accounts, bad customer accounts that go bad. So we will expense those as well. And the same thing with the warranties. So 1% of the product gets returned under warranty, so we'll have warranty expense. Okay, in expense recognition, so I've got another point here, expense recognition, there's 3 ways of recognizing expense. One is this association of cause and effect, and that's what we've got going on up here. These 3 costs really should be matched with revenue in the same accounting period. So when we report sales upon shipment, we should have these 3 expenses likewise. The credit card expense for those sales, the bad debts related to those sales, and the warranty related to the sales. Or if it's for the month or for the year, or with the credit card expense for that month, what's the bad debts for that month, and the warranty. Now these last 2, we don't really know. We don't really know at the time of the sale which accounts are going to go bad. If we did, we wouldn't sell it to them, right? Like, same thing with the warranty. We don't know which product will be deficient. If we did, we wouldn't sell it. So these 2 we have to estimate. So we get some gray area now in accounting because we have to come up with an estimate in order to apply this matching principle. So in order to report bad debt expense, we have to estimate what the bad debt expense for those sales will be. We have to estimate what the warranty cost will be for these sales in order to match it with the revenue. So that's association of cause and effect. And these 3 costs typically are considered product costs. Product costs, right? Because they're the cause and effect with that. The other kind of expense recognition is just immediate recognition. There's no cause and effect. Salaries, advertising, R&D, research and development, all of those are just recognized and expensed when they happen. So we just, whenever we incur those costs, we just expense them right away. Those are typically referred to as period costs. They're costs of the accounting period. So if our accounting period is a month, those are just a monthly cost. If our accounting period is a year, it's an annual cost. And then the last one we typically see with something like rent, insurance, and depreciation. We allocate those costs, and it should be some sort of systematic method. It should be rational as well. But we're just allocating cost over time. So again, we're just allocating cost over time for those. And those also are considered costs of the accounting period. So those are period costs. So again, we have product costs related to sales that we match with sales, and then our period costs are these down here.